Okay, it's 8:30 and the system is actually working. Oh, yay. Okay, so we're gonna rock on here because we have a lot to catch up on. All right, so that was the assurance type warranty approach or the expense approach. Now I want to look at the revenue approach. So in this one, we're looking at the sale as if it is a multiple deliverable. In other words, a bundled sale. We're selling a product and a warranty. That's just kind of the mindset we're taking for this one. So we're going to assume that sales in 2027 occurred evenly throughout the year. Warranty agreements similar to this are available separately and are estimated to have a standalone value of 600. So that's the sales value. This is the same question as the previous question. So the sales value related to these costs, right? These costs sum up to 488,000. The sales value is 600. Okay? Everybody good with that? They're earned over the warranty period as follows: 15% in 2027, 35% in 2028, and 50% in 2029. So as the product's getting older, more of the units are incurring problems. Prepare the entries to record. So first of all, do the entry for this. Then prepare the entries to record the 68,000 expenditure for servicing the warranty during 2027 and the adjusting entry required at year end, if any, under the revenue approach. Okay. So first, we're going to book the sales entry. But this time, we're doing it as a bundled sale. So it is still cash or AR for 2.5 million. But now we're going to split out the product sales for, well, it has to be 1.9 million, right? And then the warranty for 600. What will be the name of the warranty account I use for this? For the sale of the warranty? Anybody? Warranty revenue? Are you good with warranty revenue? But have we earned the warranty revenue on the day we make the sale? No time has passed. So we're going to set up unearned warranty revenue. Then during 2027, you know, the sales were happening through the year and we had warranty problems. So we're going to do this entry. Apparently the answer on Wiley Plus is materials, cash payables, or something like that. And that was 68, that what we actually spent. And then the adjusting entry we need at year end is to release some of that unearned revenue. because now some time has passed. They weren't all sold on December 31st. Some time has passed during the year for some of these sales. So we're going to book 15%, which is 90,000. Take it out of unearned and put it into actual revenue. Okay, now looking at these two, if you were a CFO, and you could justify either choice, which one is better? 50-50 chance. Which one is better? Do you want to take a shot, Caleb? It has a nice ring to it, right? I'm a CFO. I like revenue. Revenue's good. So you like revenue. You probably, as a CFO, want to report higher revenue, right? Because like you want to get the revenue in now. Who knows what could happen next year? You could be fired, someone else could be here. So let's just get the revenue booked under me as the CFO. So, okay. Well, let's see which one results in higher revenue. Okay, let's look at it. Which one results in higher revenue? Let's look at that. Look at the journal entries. Which one results in higher revenue being recognized or sales? Noah? It's the expense approach. Revenues are 2.5 million. Under the revenue approach, revenues are 1.9 plus 90. 2.5 million. So revenue, 2.5 million versus 1.99. I'll take the 2.5. What about profit reported? Like earnings before tax. Which one reports higher profitability? The profit for this one is, we've got sales of 2.5 minus warranty expense twice for 488. 2.5 minus 0.488 is 2.012 of profit. Okay, that's higher than what the revenue approach has for revenue. So profitability is certainly going to be higher under the expense approach, right? Profitability here would be 1.99 of sales minus 68 minus 90 minus 0.158, which is 1.8. 3.2? Definitely expense approach is better. Okay, what's something that CFOs don't like to report? What would they like to report less of? We don't like reporting liabilities, right? Okay, so which one has higher liabilities? I mean, our liabilities under this approach at the end of the year, 420. What are our liabilities under this approach? Noah? How much? That's not a liability. Sorry? What about this account here? It's a liability account. I know it's got that name which doesn't look like a liability, but that's a liability. So we've got 600 minus 590, we've got 510. So now, which approach do you like better if you're a CFO? The revenue approach or the expense approach? Definitely the expense approach, right? I mean, the names are kind of misleading, and you're keying into the name because you like the sound of revenue. But actually, the expense approach accelerates all the profits, all the revenues forward, and your liabilities are lower. Why are your liabilities lower? Because your liabilities are done at the cost level, whereas under the revenue approach, your liabilities are being carried at the revenue level, right? Because it's unearned warranty revenue, and you start at 600 on 488 of costs. So everything is worse under the revenue approach. Now, let's just talk about the standards. We have ASPE and IFRS. Under one of the standards, it's a lot more difficult to wiggle away from the revenue approach. Which one do you think that's going to be? Is it ASPE or IFRS that's going to make it difficult to wiggle away? What do you know about these standards, Dominic? Which one is going to make it harder to get away? No, ASPE. ASPE's the one. ASPE's more Wild West. You can get away with stuff in ASPE. IFRS, under the thumb. They tell you what to do. They're very specific. Now, usually, the conditions when you have to use the revenue approach are the ones that I describe here. There is a warranty available as a separate service, and it has a cost, like a price that's out there in the market. That's when you get pushed into the revenue approach. If it's just a warranty that is, just goes with the product and you can't get it otherwise, then you can, even under IFRS, you can go to the expense approach. Under ASPE, I feel like you can get away with the expense. You can just wiggle away and stay with the expense approach. ASPE, easy going. IFRS, very uptight. Okay. I need you to be able to tell me these things about the two approaches and quantify it too. You've got the journal entry, so if I ask you, or if I set up a question where I say they're really close on their debt to equity covenant. Well, you'll be telling me, pick the expense approach if you can, because from a liabilities perspective, it's lower, and you could tell me the amounts. And equity, well, that's where profit closes into equity, so you can tell me plus profitability is higher. So under the revenue approach, I have more debt and less equity. Not good. I'd rather have less debt and more equity, and that's going to help me meet my covenant, right? Okay, let's keep going. Now we're going to go to contingent liabilities. The first multiple choice question here is what I call it, like a learning multiple choice. So the answer is pretty easy. Under IFRS, with respect to threatened litigation, which of the following factors needs to be considered? All of the above. Under ASPE, which basically has essentially the same rules. They say it a little bit differently, but it's essentially the same. Under ASPE, a contingent liability is recognized if what? It's going to be basically the same as this. Different words are used in the standard. Is that big enough? Do you want? No, it's really blurry. Why is it blurry? Let me just see if I can. That's definitely better, right? Okay. Are we, can you still, okay, so under ASPE, what is it, A, B, C, or D? Ethan? Yep, it is C. I want to get my solutions out in case I have to calculate something. Yes, it's C. Okay. Which of the following may be accrued as a contingent liability? These are typical contingent liabilities. Threat of expropriation, where the government wants to build a highway. Your front lawn is in the way of the highway, so it just tells you that it will be buying your front lawn and the highway will go in front of your house. That's expropriation. Pending or threatened litigation. This is the most common one that we see. Guarantees of indebtedness of others if those others suddenly start to look shaky. So it's all of the above. So let's look at this question. Wilton is being sued for illness caused to local residents because they exposed them to chemicals. The lawyer states that it's likely Wilton will lose the suit and be found liable for a judgment costing anywhere from $600 to $3 million, but probably $1.8 million. As a result of the above facts, what amount should Wilton accrue and or disclose? So accrue, we're going to do a journal entry. We're going to put it on the books. Disclose, we're just going to write it in the notes, but we won't put anything in the books. So in order to recognize the liability, okay, factors in determining whether a liability should be recorded, in other words, whether we should accrue, are the time period. And we say it here under ASPE, as of the financial statement date. So the first one, is it a result of a past event? Is this a liability that has happened? I mean, yeah, because we exposed people and we're being sued. So like, it's not something that might happen in the future. It's happening. So that's, we met that. Okay, it is being sued. Pending or threatened litigation, and they did expose people. So that's met. The second, likely to result in an outflow. Oh, in an unfavorable outcome, how about? Is that met, Ethan? It is met. And you know what makes it good evidence that it was met? A lawyer, someone who's an expert in this litigation stuff, says, you're going to lose. You're going to lose the suit. So look at settling. And the third, can we Do we have a reasonable estimate? And we do have a reasonable estimate. They say it's 600, or the lawyer says it's 600 to 3 million, most likely 1.8 million we'll have to pay. Okay, what amount will we accrue? Ethan? Sometimes lawyers know that there's like a formula that judges typically use. So they could say, you know, I've seen it range this far, but judges typically use a formula that's going to put us right around here. You know, and sometimes it's pure guesswork. So we don't know what the situation is here, but the lawyer feels they can give us a most likely amount. So when you do have a most likely amount that some expert, you know, a bona fide expert, not Joe Blow on the street, not me, who's not a legal expert, like what I say, who cares? But if someone who works in the field says most likely 1.8, then we can rely on that. So then we would accrue, and it would be, to accrue, we just debit, let's say, litigation expense and spill liability, some kind of liability, accrued liability for 1.8 million. You know, I'm very open to whatever, you know, descriptive account names you want to use, as long as I see that it's a liability. Okay, now let's say that the lawyer doesn't give us a number. Let's just take that possibility. If there is no particular amount that the lawyer thinks is likely, then we would do different things under ASPE versus IFRS. So what do you think the two possibilities, or give me one possibility. If all you had was a range, the range is 600 to 3 million. Okay, go for the higher amount. So Sean, Peter, and Zachary, you guys switch places, right? Okay. Are you good at saving money, Sean? I feel like people who want to report liabilities as high as possible are like kind of conservative in the way they look at things. I don't want to overstate myself here, but actually in the handbook, no, that's the one that we don't use. We're not going to use the high end. We might use the low end, and the other one that we might use would be what? The average. Yeah. Okay, so it's either average or low end. So one of the two requires the average. I mean, technically it's the average. No, it's the average, but technically it's the expected value, which is if every amount between 600 and 3 million was equally likely and we did an expected value, it would be the average. Okay, between ASPE, which one says use the low end and which one says use the average? Right, because ASPE's more Wild West. ASPE's going to go at the lowest end. They still require you to disclose the full range in the notes, but what you accrue is the low end. Okay. Let's do a question here. In preparing Cehodo Corp's December 31st financial statements under ASPE, so you need to know what you're under to do this, right? The VP Finance is trying to determine the proper accounting treatment for each of the following situations. As a result of uninsured accidents during the year, personal injury suits for 350 and 60 have been filed. It's the judgment of their lawyers that an unfavorable outcome is unlikely in the 60 case, but an unfavorable verdict of 225 is likely in the 350 case. Okay, so to answer this question, I would probably ask you on the exam, what are the criteria we need to meet to accrue a liability? So the three criteria: results from past events, unfavorable outcome is likely or probable, and the third one is we have a reasonable estimate. It's an and condition. If you don't have all three, then you don't accrue a liability. Needs to be all three or no liability accrued. So let's split the first one between the 60K and the 350K. Okay, do they result from past events, these lawsuits? As a result of uninsured accidents during the year. So the cause, and they had uninsured accidents and lawsuits have been filed. So does it result from past event? Yes. Is an unfavorable outcome likely? Okay, Peter, you're nodding to me, but there's two things here. Is it likely for both of them? Sean? Okay, so now I'm done with the 60K. I mean, the estimate is 0 if it's unlikely, right? So this one I'm not going to accrue. The 350K, do we have a reasonable estimate? Yeah, we do. And that's the amount that we're going to actually accrue. Debit litigation expense, 225. Accrued litigation liability, I mean, whatever you want to call it. Disclosures. Nature of lawsuit and amount requested, like the 350. You would say we've been sued for 350. Our lawyers think that's ridiculous, that it's going to be lower than that. Currently, we estimate 225. Okay, let's look at the second one. Whoops. Oh, God. Okay. In early 2027, Cehodo received notice from the Environment Ministry that a site they'd been using to dispose of waste was considered toxic, and they're going to have to clean it up. So the VP Finance discussed the situation over coffee with the VP Engineering. The engineer says it's going to take up to 3 years to figure out how to remediate the site. and it's going to be expensive, maybe 500 to 2 million or even more. The engineering VP advocates recognizing at least the minimum estimate of 500. The financial VP says we should just disclose and say that we're not able to estimate the cost right now. So let's look at those three things. For the second situation, do we have a possible liability that results from past events? Oh, okay. Do we have a possible liability that results from past events? We definitely do. Is an unfavorable outcome likely? In other words, we're going to have to pay out money. It is likely because they've said we have to clean up the site and we don't even know how we're going to do that, but we know it's going to cost. Do we have a reasonable estimate? Why no? Sean is also saying no. Why no?
As long as you don't have like a reasonable estimate or anything. I mean, you really put like a price on that thing. Like if you put it on an average, like I can't do the math right now, but if you put it on an average, is that really like a price, or like do you have to pay more or do you pay less?
Okay. Peter? You mean even more than 2 million? Yeah. So you think like the engineering VP, you should accrue it then? I think this one could go either way. I mean, they're trying to make it ambiguous. They describe the situation as they chatted over coffee. This is a back of the envelope type of thing, right? This is not they don't even know how they're going to remediate it. So this is a time when maybe you could get away with saying that we just don't have a reasonable estimate, therefore we're going to accrue nothing, but we're going to disclose. Like just for me, I'd have a hard time not putting the 500 down. Just, that's like a personality thing, right? In my judgment, we should put something and then accrue it. But if you told me in this situation, like on a case, this is too preliminary. We just don't know. We should explain that we just don't even know how we're going to remediate it yet. I mean, the notes, it says right on the financial statement, the notes are an integral part of these financial statements. So if you don't read them as a user, I mean, that's your problem. Ethan?
This isn't like, we're not talking to a lawyer, right? Talking like, we're just like chatting, like the idea of it.
I agree, but I would say that the VP engineering is an authoritative person here because it's not a lawsuit from the government. It's an order to clean it up. Right? So who are the people you ask about that? Engineers. Right? So that's a good expert. I mean, maybe you need to hire a company that specializes in that to get a really good estimate. But an engineer is certainly in a better position than the CFO to say, that's going to be costly. Ethan?
This is like, don't really know. Like the real question should be like, can we do something fraudulent? Like, could we do some like fraudulent things that like may or may not be figured out by an auditor, but like that's like.
You see part C here? Ethical issues in accounting for estimates. There are ethical issues with estimates. If you're the CFO, people want to make their bonus. You book 500, maybe that means the whole management team doesn't get their bonus. But if you don't book it, if you say, look, it's too back of the envelope, they're not likely to say to you overtly, if you book this, we lose our bonus. It's like, whoa, Ethan, look at that. We are so close to making our bonus. And then you start talking about the contamination, and the CEO says to you, that's really back of the envelope at this stage, isn't it? This is how these things work, how pressure is placed. They don't, it's like a mob boss, they never tell you directly, kill the guy, kill the booking. They suggest in a roundabout way that wouldn't that be a good idea? And then they see if you agree. I mean, there are ethical issues. It's not easy. But since we're in a textbook world here, and, I live at a university where I can always feel like it's easy to be ethical, I'm going to say I think there is good enough to be a reasonable preliminary estimate. So I'm going to book 500. But if you didn't and you explained that well, I'd say fine. Okay? Debit. What did I call it in the solution? I called it remediation expense. Accrued remediation liability. You could just say accrued liability. I'm going to put it in at 500 because I would still disclose nature of issue, status, unknown, how to remediate. Like, haven't figured that out yet. Cost range. Okay. Third one. They have a foreign division that has a net carrying amount of 5.725. A foreign division. Like an investment in sub? Okay, so they have an investment in sub sitting on their books on the asset side. 5.725. The fair value of this subsidiary, 8.7 million. But the foreign government has told Cehodo that it intends to expropriate the assets and businesses of all foreign investors. So the foreign government is saying, yeah, you'll be selling that to us. And based on settlements that other firms have received, we expect to receive 40% of the fair value. So, it's in another country. They can do that. It means that people are not going to invest in that country very much in the future. But for now, they can just do that. I mean, they're the government, they're the sovereign. So they're going to get 40% of the fair value as compensation. 40% is 3.48 million. Of 8.7? Okay, so we have this in mind. Is there a possible liability that results from a past event? I mean, we've been notified that they are taking our company, our sub, right? They notified us. It's not a maybe. The foreign government has told us that it's going to expropriate. So I'd say, yeah, a past event has happened here. And sometimes you can even argue about whether the event has occurred, because they've notified you that they intend to. So does the intend make it hasn't happened, or does the notifying make it that it has happened? Let's go with the notifying says that it has, it's just a matter of getting the documentation, the paperwork done. Is an unfavorable outcome likely? Yeah, because they're going to lose money. They're going to get paid less than fair value. Do we have a reasonable estimate? I think we do. So we have this possible loss. I think we just book it as a loss. I mean, it's our first estimate of the loss, which is going to be the 3.48 million of proceeds we expect to receive minus our 5.725 million of book value. That is 2,245,000 loss. And now I'm going to write down the value of that investment. Right, the investment in sub, I'm going to write it down to 3.48 million. By reducing it by 2.245 million. That doesn't work, does it? Oh yeah, 3480, that's why. Minus 5.7252245. Okay, last one. Oh, it's up here. Cehoto's chemical products division consists of 5 plants and is uninsurable because of the special risk of injury. So no one will insure them, they have to self-insure. Consequently, they must self-insure. 2027 is one of the safest in the division's history because there were actually no losses to injury or casualty. Usually, they suffer an average of 3 casualties a year. And it costs them somewhere between 60 and 700. And management is certain that next year, they're really not likely to get to no liabilities. Investment in sub? Subsidiary? Okay. Do we have a liability resulting from past events here? Like we had no injuries this year, but for next year, very unlikely we're going to have none because usually they have 3. Okay, so is there a past event here, Ethan? Yes. We don't have a past event. We are talking about the future. Manage is certain that next year, well, next year then we'll book the liability when it happens, but we're not pre-booking it. It's not that something has happened. We think it's likely that it could happen, but it hasn't happened. So we don't have the first part, results from past events. No entry. Pardon? I wouldn't. What? The disclosure, the notes are talking about this year. What did things look like at year end and over the past year? We had no injuries, we have no liabilities. I don't think I'd disclose it. Maybe you'd say something in your MD&A that, but I'd place it in the MD&A as, we had an awesome year. We had no safety issues, and we hope to maintain this record. That's what I would say, which is totally honest. Ethical issues. Leeway. Leeway in interpreting these things don't come with like percentages attached to them. It's judgment. So if it's close to 50-50, maybe it's not probable. Maybe it's just below. Maybe it's just above. You get pressure. And then the other one, which we talked about, leeway in interpreting reasonable estimate. It's really annoying when other people know the accounting standards because they can come at you with the standard and I feel like they can use the standard against you. Instead of you saying, no, the standard is this and we really have to. You kind of close off discussion. But when they know it, they say, well, doesn't the standard say? And it's like, well, yeah, it does. So then you get into the pressure. Okay. Let's look at AROs. Or that's the way it's referred to in ASPE. If you search asset retirement obligation in IFRS, doesn't exist in IFRS, they call it a decommissioning provision. Now, just let's not get confused here. Could an IFRS, like a statement under IFRS rules, could it report an asset retirement obligation? Absolutely. It's the same thing. You can name your accounts the way you want to name them, but if you're searching for it in the standards, search for decommissioning provision. I mean, in the standards in IFRS, they call a balance sheet a statement of financial position. They never say balance sheet. Does that mean they don't have a balance sheet in IFRS? No, it does not. Could you call your balance sheet a balance sheet if you're reporting under IFRS? Of course you can. So it's just the words that are used in the standards, but the concept, it's the same concept and you can call it what you want in your books as long as it's clear to the reader. Ethan?
Thank you. Your previous question, question 2. Could we have credited asset retirement obligation?
Yes, because it's going to be 3 years before we figure it out. That's getting on the edge of an ARO. I agree. Usually AROs are something that, you dig a big hole in the ground and you put in like this, like the one we're going to do. Okay, they put in a big oil tank in the ground and it's going to leak a bit. So from the beginning, that you're going to have to fix that at the end. Not like there was some kind of an accident, something got spilled, and now we have to clean it up. You know what I mean? This is more like we know we're going to be damaging the site. in advance, and we're just preparing for that from the start, as opposed to an accident or an unexpected spill happened. Okay. An ARO should be recognized under ASPE when? And the answer here is C. There is a legal obligation to restore the site of the asset at the end of its useful life. So see the context? You knew from the start that you'd have to restore it at the end of its useful life. At the time of recognition of an asset retirement obligation, the way we record these obligations is we try to estimate what's it going to cost to restore that site in the future, and then we present value it to today. Because often we intend to use these assets for many years. Present value it to today. So when we're booking it, the present value should be, what do we do with the other side of the asset retirement obligation? Ethan? Yes. I mean, this is the answer on the face of the financial statements. The answer deep, deep down in your books is really this. In the books, we usually segregate it. Like it'll be bundled with the asset itself, but we keep it separate and we track it separately. Because, you know, our estimate of what it's going to cost, let's say 20 years from now, could change, you know, as time passes. So we want to keep that part of the cost segregated. So this is kind of technically the right answer, but on the face of the financial statements, it all gets bundled together. You know, like on the face of the financial statements, they might say fixed assets. That's the building, that's the desks, that's the computers, that's all of it put together. But deep in the books, they're all segregated, right? So deep in the books, the long-term asset generated by this is separate from the obligation. What am I doing? 9:23. I have till 9:50. Okay. Okay, so let's look at crude oil. Crude oil purchased an oil tanker depot on July 2nd at a cost of $600, expects to operate for 10 years. After the 10 years, they're legally required to dismantle it and remove the underground storage tanks. It's estimated that it will cost $75,000 to do this at the end of the depot's useful life. They follow ASPE, record the ARO at 75 or at the present value of 75. And the answer is at the present value of 75. Oh, sorry. Is that okay? I just want to flip back to, remember Pendlebury? Just so that we don't have any confusion. In Pendlebury, we just put the number that they gave us. That's because they made this statement. The fair value of this obligation at December 31st is 46. That's different from what we have here. Which is, it's estimated that it will cost $75,000 to do this at the end of the depot's useful life. You see how they said a fair value for the estimate is 46 today, versus this one is saying it's going to cost 75,000 10 years from now to do this. And that's usually the way the information comes at you. It's going to cost X dollars in the future to do this. That's certainly the way I'll be giving it to you. So you have to present value it to get something that you can report today. Okay, so the present value factor is, I'm just going to tell you, at 6% for 10 years, and somewhere in this question, they told us to use 6%. I don't see that I wrote it here, but in the actual question, I'm sure it says that. Oh, there it is. Calculate the present value of the ARO. That is its fair value, the fair value of the ARO on the date of acquisition of the day you purchase the oil tanker depot based on an effective interest rate of 6%. So the 6% was actually in Part A. Prepare the journal entries to record the acquisition of the depot and the accrual for the asset retirement obligation. So if we multiply that times our 75,000 expected future cost, the value is 41,879. That's the present value. And that's the amount that we're going to record the asset retirement cost at. So let's do the journal entry. Prepare the journal entry to record the acquisition of the depot. Debit, tanker depot. $600. And tanker depot ARC, asset retirement cost. 41,879. Now, on the financial statements, we're not going to show these two separately, but in the books, we will carry them separately. So on the face of the financial statements, we could say tanker depot 641,879. Then for the depot, let's assume we paid cash. But we certainly didn't pay cash for the asset retirement costs, right? That's an obligation we will pay in the future. That's our ARO. That happened on July 2nd. What happens to these things as time goes by? Well, your tanker depot plus the ARC, it's a fixed asset, right? It has to be depreciated. So we're going to depreciate it over 10 years. Debit depreciation expense. $600 over 10 years times, it's only 6 months, right? Because it was purchased in July. 30,000. This one, not quite as easy to calculate. 41,879, also over 10 years. Also times 6 over 12. It is 2094. So our depreciation expense, 32,094. I'm going to show the accumulated depreciation account separately because I showed these separately. If you combine them on the exam, I'd be fine with that. I mean, if you combine them, I still think that you get it. If you just said accumulated depreciation, 32,094, I think you get it. The ARO. The ARO starts at 41,879. But 10 years from now, we expect to actually pay 75,000. So by 10 years from now, that ARO account needs to be 75,000. So what we're going to do is accrete it each year, grow it. As the time between today and payment date shrinks, it's going to get bigger and bigger and bigger till it hits exactly 75,000 as of the date 10 years from purchase. And the way we do that is we just multiply the amount we have by the interest rate. So this is called accretion. We're going to take the 41,879 times 6%. And of course, we have to prorate it for 6 months. Debit, accretion expense. That amount is $12.56. Show a partial balance sheet with the fixed assets and liability section. Give me a good title. Crude oil. Partial balance sheet for the year ended December 31st, 27. On the asset side, I would say we have a tanker depot. Like on the face, I'm just going to add it together. Cost $641,879. Less accumulated depreciation, $32,094. I have assets sitting there of $609. Liabilities side, I just have an ARO. And it is 41,879 plus the 1256. $43,135. That's what I would actually show on my balance sheet as a result of these entries. How would accretion expense be reported in the statement of cash flows? It's non-cash, right? We're not paying out anything with this accretion expense. We're just building up to the 75 that we expect to pay out at the end of 10 years. So non-cash added back in the operating cash flows section. Okay, so let's just think through. We have a cost of 75,000 that needs to hit the books, needs to hit the income statement. How does the 75,000 hit the income statement? We have 41,879. So between 0 and 41,879, that hits as depreciation expense over 10 years. And then from 41,879 to 75,000, that hits as accretion expense over 10 years. Right? So the $75,000 cost does hit the income statement over 10 years through these two lines on the income statement: depreciation and accretion. Depreciation is going to hit flat every year, the same amount. And accretion, is it going to be flat? Is it going to increase, or is it going to decrease? Over the 10-year period, what's the profile? Every year, we take whatever the balance is of the ARO and multiply by 6%. So it's going to grow because every year it's going to be based on a higher number, right? It's going to keep growing. So depreciation stays flat, accretion grows a little bit. So it's not a flat hit to the income statement every year. It's like a sloping upward hit to the income statement. And ultimately, over 10 years, $75,000 will hit the income statement. In fact, we can figure out what the accretion table looks like for the first three lines. Sorry. Okay. The accretion table, this is like a bond discount table. It's just a present value table. So for 2027 to 2028, our opening ARO on July 1 starts at 41,879. Accretion expense. We booked half of it here because we prorated for the 6 months. But if we didn't prorate, and this is A, this is just A times 6%, which is 2513. Ending ARO is 41,879 plus that equals the ending ARO, 44,392. Then bring that down here. 44,392. That's where it starts on July 1st, 2028. So over 2028 to 2029, we take 44,392 times 6%, it is 2664. Now we've grown to 47,055. Bring that down. Multiply it out. 2823. See how it's growing? That's just the first three lines. This would be 10 lines long, right, for each year of the life. And at the end, at the very end, after we've done 10 lines of this, the ending ARO value is going to be exactly 75,000. Why? Because we present valued it using the 6% interest rate from 75 down to, purchase date at 41,879. So, we set it up so that it's going to grow to 75,000. Okay. Here we are. Fast forward 10 years. It's June 30th, 2037. Crude oil pays a demolition firm to dismantle the depot and remove the tanks, and it cost 80. They estimated 75, it actually cost 80. Not bad from 10 years back. Not a bad estimate. Good job. What is the accreted value of the ARO on June 30th, 2037? Because now we're going to settle the ARO. We're going to remediate the site. We're going to fix this. What's the value of our ARO at June 30th, 2037? After all these things have happened, Sean? Yeah, remember it's going to grow to exactly 75. The actual cost to retire the depot was 80. Okay, so let's just think through our journal entry. First, we're going to get rid of the ARO. We're going to debit it because we don't have the obligation anymore. We've done it. And then we paid the guys 80. And we did pay them. I need a 5,000 debit to balance. What is that? Yeah, additional demolition expense, I could take that, or loss. You know, loss because we estimated incorrectly. I'll put demolition expense. Loss on restoration. Just, it needs to sound like an expense, like it needs to sound like an expense or a loss. So as long as you describe it that way, I'm good. Okay. Let's keep going. Just a quick moment on customer loyalty liabilities. You know, when you get points at like Shoppers Drug Mart or Aeroplan points, the company is committing to give you goods for free in the future, right? Under IFRS, okay, ASPE doesn't really say anything about customer loyalty, but IFRS does say something because they would, right? They would. That's just the IFRS mindset. They would. Does anyone know how IFRS requires you to account for customer loyalty programs? Ethan? It is D. The proceeds are to be split between the original transaction and the award credits. You know what this sounds like? So you go to Shoppers Drug Mart and they record debit cash, you paid cash, credit, sales, shampoo, bought a bottle of shampoo, credit, unearned revenue. So you get points, and let's say it's worth 2%. You bought a $10 bottle of shampoo. $9.50 actually comes in as revenue, and 50 cents goes to unearned revenue. That's how you have to book it under IFRS. What does that remind you of that we already did today? It is, yeah. Just like a warranty, they're requiring you to treat those points as a bundled sale for goods that you'll get in the future and goods that you're getting today. IFRS requires that. ASPE does not. ASPE would actually, the way the standard is written in ASPE, you would essentially be doing the expense approach. Just set up a liability for it under ASPE, not the revenue approach that is, of course, required by IFRS. You know, IFRS does not let you wiggle away from it. ASPE lets you do expense approach. Even though ASPE doesn't say it directly, the way the revenue standard is written, it doesn't really allow for this with loyalty points. really you have to set up a liability. Okay, well, they're done, but we've still got 5 minutes. So let's keep going. Harudka. You'll see that this question shows up relatively frequently on the exams. Like you'll look at the old exams and you'll see what questions I ask. I find this is a good area. So Harudka has manufactured a broad range of quality products. The operating cycle of the business is less than 1 year, which means that current assets are anything 12 months or less, okay? If the operating cycle is less than 1 year, then we assume 12 months is the definition of current. The following information is available and they follow ASPE. Harudka has 4 million of bonds payable, which were issued at par in 2016 and are due in 2036. They carry an interest rate of 7% payable semi-annually each June 1st and December 1st. Okay, so when we're thinking about what current financial liabilities are related to this, the bond is already on the books for 4 million, right? Because it was issued way back. But the current liability, well, our fiscal year end, and if I ever give you an off calendar year end, like just note it down, circle it, highlight it, because it's easy to get your month counts and your proration wrong, because you think automatically of December 31st, a calendar year. So I would just keep reminding myself, oh, she's done it. She's given me a nasty year end. Okay, so if the fiscal year end is February 28th, then for this bond, when was interest last paid on this bond here? What was the date, Sean? December 1st of 2026, right? Everybody good with that? Okay, so then we need to accrue interest for December 1st through February 28th, right? Because no interest has been paid, but we are incurring that cost. December, January, 3 months. Means we should go home with 2 minutes to spare. Bring this back and we'll finish. Like I got behind with you guys because of the problems with the system. So just bring it back along with the long-term liabilities next time on Tuesday. And have an awesome weekend. Looks like it's going to be nice.
Thank you for the lecture.
Okay. See you, Dominic.
Good weekend.
You too.